Hey, hi. So in this short video series, I would be discussing as to how do you analyze a bank, okay? And so essentially, I would be talking about uh, four things. One is uh, the ROE metric. Why is the return on equity metric important for banks? What drives the ROE metric, okay, which is essentially the DuPont formula. Second is, okay, the asset and liability profile of a bank. How do you assess the asset and liability profile of a bank, which drives the return on assets? Okay. Two. Third is, I would also spend some time discussing the various risks that you need to assess while evaluating a bank. Okay. For example, I would be talking about the asset liability mismatch with, and the couple of crises that have happened both in India and in the US because of asset liability mismatch. Okay, there are a couple of ways it has manifested, a couple of different ways it has manifested. So I will be talking about that risk, okay, and the lessons that we can draw from that crisis that happened, okay. And then finally, we were talking about relative valuation for banks, okay, and uh, and why we prefer a certain metric over the other, okay. And absolute valuation, DCF valuation, that I would be discussing in a separate video. A lot of people do not like DCF for, when DCF is applied for banks, just fine, to each their own, all right. But I'll be making a separate video on that, all right. And yeah, and banking industry, before we get started, banking industry honestly is very, lending is very exciting, and especially for India. Uh, I was watching an interview, uh, of a person whom I've started following very recently. His name is Ajay Sharma. He's a hedge fund manager based out of Singapore, and he goes on to say in his interview that in your portfolio, 20% ideally should be allocated to financial institution like lenders, because it's lending that is going to fund all the economic activity that is going to take place in India over the next decade or so. All right. So one should have quality lenders in their portfolio. Okay, that's one. And the other thing which is exciting about banking is that the current lending market size in India is around 170 lakh CR. Okay, so it's around 170 trillion rupees. Okay, and this market is more than quadrupled, 4x every 10 years starting 1950, and this trend is expected to continue, moving forward. So it could become around 600 or 575, 80 lakh CR in 10 years from now. Okay, given the low penetration that we are at today. And another thing that's exciting, that has unfolded in the recent past, okay, and the trend is expected to continue, is that private lenders have gained market share from 20% to around 40%. Yeah, so again, so hope you, with that said, let's jump in. Let's dive into the details, and hope you enjoy the learning process. And if you find this content valuable, then please consider subscribing and sharing with people who you think may benefit. All right. Thank you. Let's start. See, banks, they you go to a bank, you deposit your money. Okay, so those deposits, okay, which a bank has, for banks, they are liability. Liability क्यों? Because banks are supposed to return that money. वो bank का नहीं है. Okay, but you go to a bank to deposit your money, and bank in return they pay you an interest. Okay, all right. So that's the liability side. Okay, and then the banks they use that money. Okay, and they give out loans to different customers. Okay, and on those loans, the banks they charge a higher interest. Okay, so those loans, those loans are assets for the bank. Okay, all right, and the differential in the interest on loans that they give out, and the interest on the deposits. Okay, so the interest on the loans that they charge and the interest on the deposits, okay, that they give out, that differential they earn through that differential. Okay, all right. So ये तो like straightforward. This is the business model. This is how a lender, a bank institution, they work. Okay. Now let's understand what are some of the key metrics, okay, that you should look for when you evaluate a bank. Okay. So let me share my screen. Okay. See, one of the key metrics that you should look for when evaluating a bank is look for return on equity. Okay. And return on equity for a company is how much money that company makes on 1 rupee of equity. Equity is company ka khud ka money, that is company's own money. So how much money a company makes on 1 rupee of equity or $1 of equity is, that is what return on equity is. Okay, but one thing, why is ROE important? Why I'm like stressing on ROE? Okay, see, long-term stock compounding for banks, they follow book value per share compounding, okay, which in turn depends upon a bank's ability to deliver high ROE over the long term. Okay? That's why ROE is very important. Okay? So all the analysts, they track ROE. Okay? But obviously ROE is not sufficient. Okay? So, but first, let's look at the ROE of the leading banks in India. SBI is a public sector bank, ROE 17%. HDFC, ICICI, Kotak, Axis, they are private sector banks. So unka ROE यहाँ पे mentioned. All right. Okay. Now let's take it a step further. I said ROE is not the only metric that obviously you should look at. So, see, if this equation, return on equity, profit after tax by equity, okay, if I multiply and divide by assets, okay, then the above, this equation can be rewritten as ROE is net profit divided by assets times assets divided by equity. तो इसका मतलब क्या हो गया? ROE is actually return on assets. This net profit divided by assets is return on assets. Okay, times leverage. Leverage is assets by equity. Okay, but what is return on assets? See, return on assets का मतलब ये हुआ कि very simplistically talking, okay, let's say an ROA of 2% means that the lender makes ₹2 on a loan book or loan assets of ₹100. तो 2% ROA का मतलब हुआ कि 100 रुपए के लोन में 2 रुपए बैंक कमा रहा है. That is what a 2% ROA means. Okay, वो तो ठीक है, but then what is leverage? Okay, let's look at this table. Okay, look at this table. Here I have ROA and leverage listed for all these banks. Okay, so if you look at HDFC has an ROA of 2%. That means HDFC is making ₹2 on a loan asset of 100 rupees. 2 रुपए कमा रहा है 100 रुपए के लोन में HDFC और ICICI. Okay, and they are 8.5 times leverage. Okay, what does it mean? If you look at SBI, it's 15 times leverage. Okay, what does it mean? So leverage का मतलब is asset by equity. So if you look at SBI, what it means is, okay, on assets of ₹100, okay, it has an equity of ₹6.5. 100 divided by 6.5 is around 15. Okay, if you look at HDFC, it is 8.5 times leverage. What it means is, on assets of ₹100, it has an equity of ₹15. 15 रुपए का leverage. Okay, so if you see, higher the leverage, lower the equity the bank has on assets of ₹100. Okay, so that's one way to understand leverage. The other way to understand leverage is, okay, if you look at this formula here, leverage equals debt plus equity by equity. So it reduces to 1 plus debt by equity. So इसका मतलब, if SBI has leverage of 15, that means for 1 rupee of SBI's own money, it needs to borrow 14 times. HDFC, for 1 rupee of their own money, they need to borrow 7.5 times. That's another way to look at leverage. Okay, all right. So see, why I'm stressing on leverage? Okay, see, it's lower the leverage, it's better because that means you have more equity. Okay, on a set of ₹100, lower the leverage, it's better. Why? It's because when you have leveraged balance sheets, a small change in asset quality wipes out a big portion of your equity, which leads to credit agencies downgrading the stock and the stock price starts falling. Okay, that's why when you look at ROE, double click on ROE and see what is driving ROE, whether it's ROE or leverage. Okay, all right, and this is the DuPont formula, by the way. Okay, all right, so always prefer banks which have lower leverage and high ROA. All right. And one thing more, and why do you think the ROA return on assets of these banks are so different? SBI, it's 1%, Axis less than 1%. Well, for Axis, it's less than 1% because they had some legacy issues and thus they acquired the consumer business of Citi some time back. So that's why. But SBI का 1% क्यों है? So see, And even other banks like Punjab National Bank and other banks, their ROA is on the lower side. So to kind of understand कि ROA ऐसा क्यों है, let's just spend a few minutes. Let's double click on the asset profile and the liability profile of, let's say, let me pick ICICI Bank. Okay. And yeah, then you'll understand what actually drives ROA. Okay. And then you can use the same explanation to any bank that you are evaluating. All right. Okay. So let me open up the investor presentation for ICICI Bank. All right. Let me do that. Right. So here let's start with the liability profile. Let me search on deposits. So deposit may, okay. So there are two kinds of deposit. One is CASA, which is current account, saving account. The other is term deposits. Okay. CASA deposits, they are cheaper for the banks. Because banks own deposits where they don't have to pay a lot of interest. Okay. And there is term deposits like the FDs and recurring deposits, they fall under term. Okay. So CASA for ICICI is 40%. Okay. In fact, CASA for many banks like ICICI, HDFC, Kotak, it's close to, and SBI, it's close to 40%. Okay. All right. Or so in fact, let me pull over the annual report. I think it will be better to understand. Okay, so I'm on the annual report. Let me search by management discussion. So here, if you see, I'm just making sure I'm being recorded. Yes. So if you see average interest bearing liabilities, meaning both your borrowings and deposits, they are around 12 trillion rupees. Okay. Usme the bank gave an interest of around 4%, 3.93. Okay. So the cost of fund है bank का, okay, is around 4%. Okay. And if you want to break up, there is a breakup as well. कि जो 3.93% हमने देखा, उसमें कैसा if you see current account and saving account, उसमें जो interest the bank has to, which the bank paid last year, is only 2.28%. Okay. Term deposit, it's higher, close to 5%, because FDs and all, उसमें थोड़ा interest ज़्यादा देना पड़ता है, and then cost of borrowing is slightly more higher. Okay. So overall cost of liabilities, your cost of overall cost of deposits and borrowings is close to 3.93 or 4%. Okay. All right. In fact, SBI or HDFC and Kotak, all these banks ka, it's closer to this 4%, give or take a few percentage points, a few, it's around this range. Okay. तो इसका मतलब क्या हो गया? Optically, at least optically, जो deposit profile, it looks optically that is not driving the ROA change. Okay. So let's look at the asset profile now. All right. Let's do that. So let me go back to investor presentation. Okay. And I just want to make sure I'm getting recorded. Here, let me go to the loan portfolio, which is the next slide. Okay. So loan is the assets. Okay. So here, the key thing to look for is what portion of the loan portfolio is retail. Okay. मतलब कितना loan दिया है to customers like you and me, retail customers. So it is around 54%. And why it's important? Okay. It's important because see, retail loans का मतलब retail loans, personal loans हो गए, home loans, credit card loans or what have you. Okay. Plus, the key thing to note about retail loans is that banks, they earn a higher yield, higher interest rate on these loans vis-a-vis the corporate loans. Okay. All right. And the another important thing is retail loans have lower NPAs because customers like you and me are very likely to pay off any loans that we take. Okay. All right. Because we obviously need to maintain a CIBIL score and stuff. So retail customer जो है वो अब तो पैसा बैंक को लौटा देगा, कॉर्पोरेट तभी डिफॉल्ट कर सकता है. ओके. ऑलराइट. तो और रिटेल में पैसा भी ज्यादा बैंक कमाता है. ऑलराइट. ओके. सो इफ यू लुक इन एसबीआई और सम अदर बैंक लाइक पंजाब नेशनल अदर बैंक्स, ओके, वो कॉर्पोरेट को लोन बहुत देते हैं. दे लोन द कॉर्पोरेट एक्सपोजर इज हायर than ICICI or HDFC. Okay. So two things happen because the corporate exposure is higher. So they earn a lower yield on those loans. Plus NPAs भी आ जाते हैं when the tide is not in your favor उन loans में. All right. So that explains the lower ROA for those banks and higher ROA for the likes of HDFC and ICICI. Okay. That's one of the explanation. The other is if I यहाँ पे अगर मैं P income search करूँ, okay, see दो मोटा दो kind of income है बैंक का. One is net interest income, which is the interest differential loans pay, or the interest differential with the loans they give out and the interest that they are required to pay on the deposits or the borrowings. एक तो net interest income है. Okay. The other is fee income. Fee income money. What does fee income means? See, it's the income that banks would earn by processing loans, by some payment gateways or demand draft, or if you like enrolling for mutual funds. So उसमें जो भी fees होगा, that is like fee income. Okay, all right. So if a bank has higher exposure to retail, okay, then then it will earn a higher fee income, because retail customers, they transact a lot. Corporate इतना transact नहीं करेगा. जितना ज्यादा transactions होगा उतना ही ज्यादा fee earn करेगा. All right. Okay. The fee income for ICICI was 22% in FY23, 21% in FY24 9 months. Okay. For SBI, it's lower, and for other banks like Punjab, I'm just using them as my guinea pig, but obviously you got to like search की कितना fee income किसका है. लेकिन क्योंकि SBI, PNB और other banks का corporate exposure ज्यादा है, corporate लोगों को corporate companies को ज्यादा लोन दे रखे हैं, तो उनका fee income भी थोड़ा lower है. That again explains their lower ROA. Okay. And obviously you also need to check कि उनके ऑपरेटिंग एक्सपेंस और एम्प्लॉय एक्सपेंस उन बैंक से ज्यादा होते हैं. एक और रीजन है क्योंकि वो पब्लिक बैंक्स लिटिल इनएफिशिएंट vis-a-vis प्राइवेट. तो एक और रीजन है कि उनके आरओए क्यों थोड़े कम हो जाते हैं. इनफैक्ट यू कैन डू दिस एनालिसिस फॉर प्राइवेट बैंक्स एज वेल. किसका ऑपरेटिंग एक्सपेंस ज्यादा है, किसका कम है, किसका फी इनकम ज्यादा है, किसका कम है. ओके, देन यू विल अंडरस्टैंड व्हाई किसका आरओए ऐसा क्यों है. ऑलराइट. ओके, so I thought it's important that I spend a few minutes on double clicking on both the asset profile and the liability profile. Okay, all right. And yeah, so I think hope this was helpful and gave you a complete understanding of what drives ROA for banks. And in the next session, it will be small, it will be very small. I'll focus on what are some of the risks that you should assess while evaluating a bank. All right. Okay. Thank you.